Picture this. It's tomorrow morning. You wake up, you check your bank account, and today you make a bold decision. You pay off every single loan you have. Your mortgage, gone. Your credit card, zero. Your car loan, done. Your student debt, wiped. Now imagine something even stranger. Every single person on Earth does the same thing. All 8 billion of us. One morning, one decision, everyone becomes completely debt-free. Sounds amazing, right? No debt, no payments, no financial stress. But here's the strange question. If everyone became debt-free tomorrow, why would the global economy start collapsing by Tuesday? Okay, before you assume I've lost my mind, stick with me. Because the answer reveals something about money that most of us were simply never taught. And this isn't a conspiracy thing, it's just something that never shows up in most classrooms. Here's what most people believe about banks. Somewhere there's a giant vault. Stacks of cash, people deposit money, banks store it, then banks lend that money to someone else. Simple, logical, makes sense. Except that's not how modern banking actually works, not even close. And once you understand what really happens, the debt-free apocalypse suddenly starts making a lot more sense. Let me introduce you to David. David is a normal guy, decent job, decent salary, and a very expensive dream. He wants to buy a house. The house costs $300,000. Now, David, like most people, does not have $300,000 sitting in a shoebox under his bed. So he walks into a bank. He sits down with a loan officer. He hands over every document known to mankind, pay stubs, tax returns, probably a letter from his third-grade teacher. The bank checks his income, checks his credit score, checks his job stability, maybe even checks if Mercury is in retrograde. Finally, they say, approved. And this is where things get weird. David didn't bring $300,000 into that bank. The bank didn't walk into a vault and pull out $300,000 in cash. Instead, someone opens a computer, types a few numbers, and suddenly $300,000 appears in David's bank account. That money did not exist before that moment. It was created when the loan was approved. Yes, that sounds unbelievable. But this is literally how modern banking works. Banks create money when they issue loans, not printing presses, not vaults, loans. This is the part where many people say, wait, that can't be real. But if you've ever taken a mortgage, car loan, or business loan, you've already seen this system in action. Now, David has $300,000. He buys the house. The seller, let's call her Maria, receives the money. Maria deposits it in her bank, but she doesn't just stare at it. Maria hires a contractor to renovate another property. The contractor pays workers. The workers buy groceries. The grocery store pays suppliers. The suppliers pay truck drivers. One loan, one moment of keystrokes, and suddenly that money is moving through dozens of hands. This is how economies grow. New loans create new money. New money creates new spending. New spending creates jobs, businesses, and growth. The whole system runs on this cycle. Everything works beautifully until something else happens. Eventually, David starts paying his mortgage. Every month, he sends money to the bank. Now, most people assume that money just goes somewhere, into a vault, into profits, into someone's bonus who probably doesn't even deserve it. But here's the surprising part. The portion of that payment that repays the loan itself basically disappears. Because remember, that money was created when the loan was issued. So when the loan is reversed, the money is uncreated. Let me say that again because it's important. Money is created when loans are issued. Money is destroyed when loans are repaid. The amount of money in the economy depends heavily on how much debt exists. Not gold, not printing presses. Debt. Let's simplify this. Imagine David takes a $100 loan. The bank approves it. Suddenly, $100 appears in David's account. He spends it at a store. The store owner gets the money. The store owner pays a supplier. The supplier pays workers. The money spreads through the economy. But when David pays back that $100 loan, that original $100 disappears. The accounting entry that created it is reversed. The money is gone. Now let's go back to tomorrow morning, the morning when everyone becomes debt-free, mortgages disappear, credit cards vanish, business loans get repaid, student debt gone. It sounds like a perfect financial reset. But remember what we just learned. Loans create money. So when loans disappear, the money created by those loans disappears too. Let's say an economy has $10 trillion circulating, but 7 trillion exists because of loans, mortgages, car loans, business loans, credit cards. If everyone suddenly repays those loans, that $7 trillion disappears. The economy that was running on $10 trillion now only has 3 trillion left. Businesses suddenly see fewer customers. People already use their savings to pay off debt, so they spend less. Restaurants get fewer diners, stores sell fewer products, companies see revenue drop, some companies start cutting jobs. Those workers spend less, which hurts even more businesses. And suddenly, the entire economy starts shrinking. Ironically, the thing that was supposed to free everyone financially just triggered a massive recession. Now, let's make the scenario even stranger. What if people don't just pay off their debt, they also stop borrowing, no mortgages, no credit cards, no business loans? Everyone decides, I'll just save up instead. Sounds responsible, right? Let's say a young couple wants to buy a home. The average home costs $400,000. If they save $2,000 per month, it would take 16 years to afford it. By then, the house might cost $700,000. Businesses face the same problem. Opening a restaurant might require $300,000 upfront, equipment, staff, rent deposits. Without loans, many businesses simply never start, which means fewer jobs, less innovation. This is why economists say modern economies depend on borrowing. It's not a bug in the system, it's a feature. I want to be clear, this is not me saying go rack up credit card debt. Please don't do that. Personal irresponsible debt is still a nightmare. This doesn't mean personal debt is good. High interest debt can absolutely ruin someone's finances. Pay off credit cards, avoid predatory loans, live within your means. That advice still matters. But on a system level, debt also plays another role. It helps create the money that keeps the economy moving. Loans allow future spending to happen today. Without borrowing, economic growth slows dramatically. But now, if you're thinking clearly, a new question should be burning in your mind. If the economy needs money to be constantly created to survive, why do we rely on banks and loans to do it? Why doesn't the government just create money directly? Why not just print whatever we need? History has tried this. Sometimes it worked, and sometimes it turned into one of the worst economic disasters ever recorded. Wheelbarrows of cash, savings wiped out, entire economies collapsing. That's what we're exploring in the next video, because the answer is not what most people think. If this video made you see money differently, that's the point. Most of us were never taught how this system actually works. So if you want to catch the next one, subscribe. And if you know someone who says debt is destroying the economy or just print more money, send them this video. Not to win an argument, just to start a better one. See you in the next one.